There's one last thing to do, and that's decide which trade-off of risk and return is the best for us. We know it's going to be at a return above the minimum risk portfolio. It's going to be somewhere on the efficient frontier between Walmart stock and this minimum variance portfolio, but we don't know where. In fact, we wouldn't know where unless we knew what the risk-free rate was, because we want to use the capital market line, capital allocation line, to draw a line from the risk-free rate through the optimum risk portfolio. So let's find that portfolio. We'll call it the optimum risk portfolio. But in order to optimize that portfolio, we need to calculate the Sharpe ratio. And an important input of the Sharpe ratio is the risk-free rate. Let's assume it's 2% and add a formula to our list here called Sharpe ratio. And then we can enter the Sharpe ratio for each of these portfolios. And the optimum risk would be where we would have the highest Sharpe ratio. So let's use Solver to find that. In this case, our objective is the Sharpe ratio, but we want to maximize it by changing these weights, subject to the constraint that the sum of the weights is equal to 1, and we won't constrain it any more than that. And in fact, we did find a higher Sharpe ratio. Let's add that to our chart. And let's come over here and draw the capital allocation line. We'll extrapolate that line out to the maximum risk. And add this line to our chart. Now our risk return chart goes through the risk-free rate, the risk-free asset, through the optimal risk portfolio, and extrapolates out to the highest risk on our chart.